So most people think a personal loan is just borrowing money. You apply, you get the funds, you pay it back. That's it. But what if I told you that a personal term loan used the right way is not actually a liability, it's a funding bridge. A bridge between the high utilization credit profile that's been blocking your business funding right now and the clean high score profile that gets you approved for 50,000 to 100,000 in 0% interest business capital. So the people who dismiss personal loans as bad debt are the same people who never learned how to use them as an actual funding engineering tool. So in our community, we don't take on debt randomly and we don't take on bad debt. We have to know how to engineer it. And today I'm going to show you exactly how we do that. So I'm Brittany Calloway, and my job is to help you turn credit into capital and capital into freedom. So I know this from personal experience. I went from my 550 credit score and zero business credit to over 800 and more than $2 million in funding across my different businesses, entities, and profiles. And a strategic personal term loan was also part of that journey with the exact engineering framework we use to turn personal loans into a launch pad for business capital. Stay with me because the funding brokers are going to be so mad at me for giving away the personal term loan companies that they also use and how to really engineer this the right way for high maximum approvals. So let me just also define exactly what I mean by when I say a personal term loan. I am not talking about payday loans. I'm not talking about merchant cash advances. Those are not loans. They are considered, in my opinion, predatory lending to a lot of businesses if they are not understood or used the right way strategically to build capital the right way. Now, I get it. Every business sometimes needs to use them, and I'm not saying we can't, but you have to know what you're actually using them for and how they work. So when I say personal term loan, I'm talking from a real reputable lender. The funds are going to be deposited into your bank account. This is going to be on fixed monthly payments of principal and interest. And the interest rate should be in the single digits or double digits, but kind of on the low side, and a real product from a real institution. That's what we're working with. Now, let's talk about just the pros and cons between the two. So, a strategically placed personal term loan can move your credit score and move it fast. So, here's kind of the breakdown that we have to know. When we think about personal term loans, when the credit boosts, it's all about payment history. Every on time payment for your personal term loan is actually going to be strengthening the single most important factor in your credit profile and score. Because remember, 35% is controlled by payment history. So when you're paying consistent on time payments, you're going to build a track record that lenders look very hard at. The second credit boost is going to be the utilization off your actual score. So when you guys are carrying those limits, and if you're kind of hovering over 38 to 40, 50% in utilization, you can use the personal term loan to pay down those high interest cards, and that can drop your actual credit balance and interest rate when you're paying these down or off, sometimes dramatically. So for example, if you had a $4,000 balance on a $5,000 card, that's 80% utilization. If you use $3,000 personal loan to pay that down, your utilization is going to drop to 20%, and that alone can push your score up to 50 to 75 points sometimes. These are big things that we have to just keep in mind and in consideration. The other big boost is it helps your credit mix. Lenders want to see that you can responsibly manage different types of credit. If the only credit you're holding is a revolving credit, such as credit cards, adding something like this and as an installment loan, like a personal term loan, is going to also diversify your mix, and that's going to positively impact your score. But here's what that 50 to 70 point boost actually unlocks. And this is the part most videos will never tell you. That score increase is what opens the door to 0% business card stacking and funding. When you have a clean personal profile, high score, prime lenders are now going to be competing for your application. That's the funding bridge. And here's a financial truth that most people have never been shown. When you think about a 20% simple interest personal loan, right, and that can be even high, that is mathematically cheaper and safer than an 18% compounding credit card. So I really need you to let that sink in and rewind, and let it play again. A higher rate on the personal term loan is still a better deal than on your credit cards. So credit cards at 18% compounding interest, the interest compounds monthly on your growing balance. Over 5 years, a $10,000 balance that you make minimum payments on can cost you $15,000 in interest alone. Personal term loan at 20% simple interest, the interest is calculated on the original balance only. Fixed payment, fixed term. The cost is predictable and capped. And we also want to be looking at loans that will allow for prepayment with no penalties. Those loans with the higher rate number cost you less. That's not a trick, it's just math. So you can use a personal loan to pay off credit card debt, and you're not just improving your score, you're eliminating that compound interest from your financial life and profile. So let's be real about something though, right? Most financial educators won't say directly about how to actually really do this. Not everyone has a fully funded emergency fund, and life doesn't just wait for you to build one. So when a crisis hits and you have no reserve, your options are to put it on a 24% card at 24% compounding interest or access a personal term loan at 10 to 15% simple interest. So one can dig you into a hole quickly that you might not climb out of, and the other one is structured and predictable. It's a bridge to the other side. So that's not a recommendation to borrow carelessly. It's just a reality check about which tool does the least damage when you really need it. And I need to have you guys slow down sometimes because you guys are sometimes in such a frenzy and emergency to access capital, but I need you to really think strategically about which ones to take. So this is a pro that a lot of generic personal financial videos are not going to explain to you. So a personal term loan is also used strategically for debt consolidation. That is also a great funding bridge. So again, accessing the personal term loan is not just the destination, it's the vehicle that will clean your profile so you can qualify for business capital that actually builds your empire. So that's the play. Fix the personal profile with the personal term loan, right? Reducing that high utilization. Then hit the 0% business card stacking while that score is high. That's funding engineering. You can even take the 0% interest funding to pay down the personal term loan if you need, and not pay it off fully, but just pay it down. So that way you're able to still keep the positive history. Your actual balance is going to be considered looking low. And now you've also just killed three birds in one stone with it. So that's another like pro tip as well. Now, something to note, personal loans are not a magic fix. They're real risks. And if you're not strategic, they will cost you. So every time you apply for a personal loan, the lenders, depending on which ones, will pull your credit as a hard inquiry. Each hard inquiry can drop your score a few points temporarily. And then if you apply to multiple lenders randomly in a short period, those hits stack up and lenders can start to see you doing that and they will shrink your amounts. That's why the application sequence matters. And we need to cover that in a real engineering blueprint. The brand new loan lowers the average age of your accounts as well, which accounts for about 15% of your credit score. So if your only credit is a card and you've had for 10 years, adding a new loan might actually drop your average score from 10 years to 5. So we need to be careful when we're taking this and looking at how it actually is going to boost the profile overall. Another thing I need you guys to not fall for are the traps. When several $1,000s drops into your bank account, human psychology can work against us. The balance feels available. The temptation is real. People who take out a personal loan for consolidation and then run their credit cards back up are in a worse position than before. The loan didn't fix anything. It just added a new payment. So we have to be disciplined when using this money. It's not optional. We need to be taking the money to then either double it or we're using it to pay down debt so that we can now really get higher approvals. Some also lenders advertise a low interest rate, then load you up with fees, origination fees, front end payment, prepayment penalties if you pay it off early and late payment fees. So we need to know which lenders do what before you submit an application, because the APR is not just the rate, it's the number that also tells you the full cost of the loan. So you need to know the full cost of the loan and everything that's factored in so you really know how much your money is costing you. Now, here's where we get into the real nitty gritty, right? The difference between someone who applies for a personal loan and gets denied and someone who walks away with $50,000 approval is not just luck. It's not even the credit score alone. It's also strategy and what you're actually putting on your application. So a true pro is going to fill out an application online and check the pre-qualifying ones before actually applying. because what you don't want is to apply, ding yourself again across multiple lenders. So you need to know which actual companies will let you do pre-quals without even applying. A lot of you also make a mistake because you ask for the maximum amount that's on the little slider. Size of the loan also matters too. 20 to 30% of your income is actually a safe one to apply for, as well as sequencing bureau pulls for maximum approvals. Some of you guys are just applying for the max and automatically just getting declined. So I really need to walk you guys through the personal term loan engineering blueprint, right? Step by step. So number one, qualify before you apply. Before touching the application, run this checklist, right? Because skipping this step is the single most common reason a lot of people get denied. Check your FICO score. Is it above 650? Below this threshold, a lot of the prime lenders will auto decline. You need to count the recent inquiries and new loans. If you have two that are unsecured loans open in the last 12 months, lenders will sometimes flag you as high risk. Loans that are older than 12 months are typically safe. And it does depend on the lender, but you have to know which one that's going to be more flexible than others. Also, determine your loan purpose before you apply. This affects everything, whether it's debt consolidation, home improvement, business purchase, or other. You have to know based on what your profile looks like, which one lenders are going to be more inclined to give to you. You have to match the purpose to your credit profile before you actually apply. So if you're a homeowner, you might want to choose home improvement. Thin credit profiles with no debt, there's nothing to consolidate. So how could you do debt consolidation, right? These are things that we have to be thinking about before we just click and press go. So we need to be choosing strategically. That's why this is so important, because choosing the wrong purpose for your profile can get denied or push you into a worse rate tier. A lot of you guys don't know that, and a lot of pro people are not teaching that. So for example, too, when you click large purchase, that actually is a higher risk tier. So you can expect lower limits and rates of 20% sometimes. You only want to use that for thin credit profiles with no existing debt to actually consolidate. And now also remembering the size of the ask. Again, the golden rule, 20 to 30% of annual income. Most people destroy their approval odds by asking for the max. Lenders don't just evaluate whether you can repay, they also evaluate whether your ask is reasonable or relative to your actual income. And this also goes for self-employed, so we need to be very cautious. So if your annual income is $100,000, we're asking for 20 to 30,000. Why this works is because when you ask for a max of 75,000 to 100,000, right? They know that you're not being strategic or responsible when asking for that amount, so it's going to just be a denial. If your profile supports a higher amount, lenders are going to counter, right? Lenders are going to counter offer that amount with better approvals. So you have to be precise when applying. So how underwriters actually think. So most people think DTI above 40% means automatic denials. That's not actually how it works. And understanding the real rules are going to change everything in terms of how you apply. The maximum DTI, 50 to 55%. These expenses cannot be removed. Lenders treat them as permanent risk. If you're here, there's less room to maneuver, right? Variable expenses that are heavy, like credit card payments, max DTI up to 75%. But here's why. If you're applying for debt consolidation, the underwriter knows the new loan is going to replace those variable credit card payments. Therefore, the DTI impact is effectively neutralized in that model. It's also important to note your stated income versus depositable income. Lenders are not looking what you say you make. They're looking at what your bank account actually shows. So with the golden standard, easy verification via pay stubs, consistent monthly deposits, lenders love this. When you're self-employed, you can kind of be in the danger zone a little bit. So your gross revenue is not your personal income. Lenders link directly to your personal checking account sometimes to verify consistent deposits. So you really need to be putting what you actually net and make so that we can stay in a safer zone. Because those high annual totals are going to trigger declines. Even if your annual income is high, gaps or spikes in monthly deposits are going to signal instability to underwriting algorithms. So consistent $8,000 a month beats volatile ranging from 0 to 20,000. So make sure you're really picking the right range for where you're at. Now, here's another advanced play that separates people who get one approval from people who can stack multiple approvals on the term loans. Different lenders pull from different credit bureaus, and those bureaus respond differently to hard inquiries. So when you apply with bureau awareness, you can sequence your actual applications to maximize the total funding received without each application destroying the next one. Because a lot of you guys will apply for one after the other, and you can see the amounts shrinking and declines happening more frequently. But when you know how SoFi is going to go, Lightstream, Discover, Upstart, or Prosper, and you have a defined understanding of in the order that you apply, and you know their repayment terms, who does what, monthly payments, the interest rate, and the collateral that's required, you're going to move through the sequence much more quickly. So before you apply for any personal term loan, you can also reach down to us too as well at thefundinglounge.com so we can walk you through the best ones to apply for. But that's the master checklist of knowing how to apply and make sure you get approved the first time around. So remember, is your FICO above 650? Are there fewer than 2 new unsecured loans in the last 12 months? Do we have a strategic purpose when we're actually selecting the loan? And what have we declared that matches our actual credit profile? Understanding how to consolidate that high utilization or for home improvement or for major purchase. And have we actually analyzed our debt to income ratio and our balances? And what is variable expenses like credit cards versus fixed mortgage and auto loans? So we can really calculate the DTI, right, the right way. And how are we going to verify our income? Do we have enough deposits and consistent income when putting the amount that we make? Or are we going off our W-2s and stubs? If we're self-employed, we have to calculate that differently, right? And then more importantly, the size, right? We have to request what's truly in 20 to 30% of our annual income so that we know, because oversizing will also kill the offers before the underwriters even finish reading your actual file. And also planning. Which lenders go to TransUnion, Equifax, or Experian so we can stack it across the right way. That's the difference between a decline and a $50,000 approval. It's not your credit score or even profile, it's strategy. And remember, a personal term loan is not a sign that your finances are broken. We can use it strategically and is a good move and to engineer funding sequence that ends with real business capital. So the people who stay broke don't borrow recklessly. They stay broke because they never learned how to actually use these financial tools with intention. And trust me, the people who are building real wealth are doing this all the time in engineering. They don't avoid debt. They just know how to engineer it. Because remember, we can't be going into just thinking we're going to get a loan. We're looking for a strategy. We're not trying to survive and use this to pay bills. We're using this for real engineering and a way out of debt by triggering into something bigger. And in my next video, I'm going to be walking you through step by step how to really go from a clean personal profile to a fully built out business credit profile. So see you there.